Hey, what's up guys? Joel here. Today I'm going to show you how you can incorporate swing trading into your everyday work schedule or school schedule. Also, please don't worry if you don't understand what swing trading is, as we're gonna get into the nitty-gritty of exactly what that is. So you know what? Just relax, chill, and maybe get a glass of wine or something. Well, you know what? No, don't get some wine. You should drink some water. It's good for your soul. All right, let's roll. So if you'd like to support us, please give us that like button, subscribe, and turn on the notification bell so you can get notifications of our videos when we post them. So now let's get into the nitty-gritty of exactly what this video is about, which is swing trading and how it fits in your work/school schedule. So let's go ahead and start. What is swing trading? So swing trading is when a trader buy and hold stocks overnight with the intent to sell within days, weeks, or months. So let's also look at swing trading versus day trading. What is day trading? Day trading is when a trader buys stocks with the intent to sell within the same day. So you can see the difference here. And why do day traders don't like to keep their stocks overnight while swing traders keep their stocks overnight? The reason is because of the risk associated with swing trading. And so let's go through those risks. The first risk is bad news. So it could be a bad company news, a bad political news, or a bad economical news. What is a bad company news? A bad company news is when, for example, a bad report about the management mismanaging the company's financials, for example, right? Or a bad political news would be political instability in a country due to elections or because of a coup. And the next one is the economical news. The economical news could be because of a bad job reports, or for example, in the US we have the Federal Reserve, which is the central bank of the United States and is basically in charge of keeping the United States economy afloat and making sure that it is growing. So then, as of now, as some of you may already know, the Federal Reserve has slashed down the interest rate down to 0%. But let's say for some reason tomorrow they decide to increase the interest rate all the way up to like 5%. What would happen? Basically, it would trigger investors and traders into the stock market to sell the stocks where they've made gains and take the extra gain from those stocks to go and invest into the treasury bond market. Why would they do that? Well, if the interest rate is going up, then there is more value coming out of the treasury bonds market, and also because the treasury bonds are considered to be, a safer investment, right? So let's move on. The next one is price gaps. So here I'm just going to give you a short description of what I mean by this, but we will end up actually showing you in the chart exactly later on when we get there what this is. But for now, price gaps is, let's say you bought a stock that was trading around $20, and when you bought it, you used the stop loss at $19. What does that mean? That means, so if there is a price gap, so when the stock closed, let's say the stock also closed at $20, and then the next day when the stock opens, it opens all the way down at $16. So that means there was a big gap between 20 all the way down to 16 that was not filled because something probably happened and people just sold their stocks, right? So then if your stop loss was at $19, then it most likely didn't get triggered. And basically you end up losing more than you had anticipated. And we will show this when we get to the chart. So just hang on with me. And now we got to talk about also the benefits of swing trading. What are the benefits of swing trading? What I like about swing trading is swing trading can allow you to capture most of the price action. And what do I mean by capturing most of the price action? Now, let's take the example of a swing trader and a day trader. If you are a day trader, for example, you buy and sell within the same day. So let's say we were all trading that same stock at $20. We bought it at $20. Both of us, you, the swing trader, and me, you, the day trader, and me, the swing trader, put in the same amount of money, right? But then after a certain amount of time, the day trader sold out and got off the position, right? But then the swing trader stayed into that position overnight. And let's assume that stock kept going higher and higher and higher and higher. Let's say that stock went up to like $26 the next day, right? That means the swing trader is making more money than the day trader because the day trader probably sold off, his position probably around like $22 or something like that, right? So it allows you to capture most of the price action, right? So that's a benefit of swing trading. And the next one is swing trading requires less time, and which is basically the purpose of this video, right? How you can basically take swing trading and incorporate it into your everyday school or work schedule, because it doesn't require you to be there sitting in front of the computer when the market is open and basically making these orders, buying and selling. No, you can literally automate your orders when the market is closed and you don't have to be there. So now let's go and get into the nitty-gritty of exactly what I mean here. So step-by-step guide. The first thing here is you have to decide when you're going to trade. What do I mean by you have to decide when you're going to trade? What I mean is it's not that you have to be there when the market is open so you are making the trades, right? No, what I mean is you have to find a time. So for example, personally, I am a morning person. Some people are evening people, right? So then you have to decide, are you an evening person or a morning person, right? So then during that time, you allocate like, I don't know, 2 hours where you sit in front of your computer and then you do some research. This is when you look at different companies and chart and you do a little bit of research to decide what you might be trading, right? And this is what I do. So usually, personally, I do this at night, and then the next day in the morning, I would wake up probably like an hour early so I can sit down there and go over all the stocks that I had found the night before and see which one are a good opportunity for me, right? So that's the first thing that you have to do, because this will help you to basically do all of your research when the market is closed, and also send in your orders when the market is closed, so you don't have to be there physically when the up market is open. So the next thing during that same time is you have to identify stocks that have a pattern or history of being overbought and oversold. And you can use software with scanning capabilities such as Thinkorswim, which is a trading software by TD Ameritrade, or FinViz, which is a free website. So then, what I mean by stocks with history of being overbought and oversold is basically, it's basically, for example, let's say a stock was going up, right? The stock goes up for a while, and then it gets to a certain point where it reaches a certain level, and then it starts coming down. That means the level where it probably got overbought and came down. And oversold is when it comes down, it gets to a certain level where it stops and reverts back and start going back up again. That means it probably got oversold, and then people started buying back in again. And I will show you exactly what I mean by this when we get to the chart. So please just hang on with me. Now, let's move on to the next one. Here is looking at the chart, you would have to identify the support and resistance lines. And these also kind of relate back to identifying stocks with certain patterns, right? What is a support line? A support line is where the example that I just gave you of a stock going down, it reaches a certain level and then bounces back, start going up. That level that it reaches, it's probably a support line. And then when it goes back up and then it reaches a certain ceiling and then it bounces off and start going down, that level, that ceiling is most likely a resistance line. So that's what those are. And I will show you how you can trace these lines in, for example, Thinkorswim. So let's move on. The next thing is you have to identify the time frame from which you want to trade. What do I mean by time frame? When you look at a stock charts, there are different time frames based on data aggregation. You can look at a 1 minute chart, a 2 minute chart, 5, 30, 1 hour, 2 hours, 4 hours, or the day chart. What does this mean? This means that each candle that show up on the chart is based on whatever time frame you choose. So let's say you choose a day chart, then each candle will represent 1 day. You choose a 4 hours chart, that means each candle will represent 4 hours. And I will show you this when we get to the chart. Hang on. So then, usually for me as a swing trader, I usually use the day chart to look at my position and decide where I'm going to find these support lines and resistance lines. But I also like to look at the 4-hour chart, because sometimes it can allow you to visualize and find certain support and resistance lines that you could not see on the day chart. But it could also help you to maybe, see that there is more, price action that's going to happen, and then it will help you stay in the trade and make a little bit more money if you want to be a little bit more aggressive than using the day chart. And when we get to the chart, we'll see all of this. So just chill. The next thing is, guys, don't just randomly buy and hold stocks. No, you'll have to do your due diligence. And I cannot stress this enough. You gotta do your due diligence. And what do I mean by due diligence? After you have went through all of these steps, you have to now go to Google and do a search about whichever stock that you've been looking into. Try and figure out if they have announcement of any news or anything it's coming up in the next few days. Try to figure out that. Look at also other analysts, other people. What are they talking about the stock? What is there a price target, right? So these are the things that you need to know, because these can affect the stock some way or another, and it could either affect it positively or affect it negatively. And then it all comes down to you to make sure that you have done your homework and you know exactly what you're getting into. Don't just buy and hold. And by the way, I am not a financial advisor, so don't consider any of what I'm telling you right now to be financial advice, okay? This is all for educational purposes only. So make sure that you talk to a financial advisor for financial advice. So let's move on. The next thing is placing your orders. And these orders, you can place them when the market is closed. You can either place them at night or place them early in the morning. It really depends to you and what time you think it's the most convenient for you, honestly. And what do I mean by placing your orders? When you place your orders, you have to basically know exactly where you're going to buy, at what price you want to buy, at what price you want to put in as a stop limit, as a stop loss, and what price you want to put it in as a take profit target. And what are these? Basically, when you do these kind of orders, you have to make sure that you send in a stop limit order. And if you want to learn more about how these works, please make sure you go check out me and my brother's videos on Robinhood and Weibo. And also, if you want to learn more about stop loss and profit target, please make sure you also go check out my video on making $100 a week trading penny stocks. And I go a little bit more into how you can manage and plan out your trade. So make sure you go check that out, and I will make sure that I also link those above. So here, what happens is, let's say you're buying a stock that is trading at $20. And then you tell yourself that you're going to put a stop loss at $19 and then put a take profit target at $22. What does that mean? That means you're going into this trade to basically say that, hey, I want to buy this trade at $20, but if this stock goes below to $19, sell it automatically for me. Also, if this stock goes above to $22, set it automatically for me. So in either one of those scenarios, in one of them you're making money, and the other you're losing money. But then look at the difference. Is the stop loss you're putting it $1 below the price at which you bought. The profit target, you're putting it $2 above the price at which you bought. What does that mean? That means you're going into this market for every $1 that you put in the market. You are willing to lose $1, but you also have a potential to make $2. And I will show you exactly how all of these works. And also, last thing that I forgot to say is, how can you determine where you're gonna buy and where you're gonna put the profit target and when you put the stop loss? That really honestly depends on the support lines and resistance lines, and I will show you. So let's go to Thinkorswim. So now that we are in here, I have the chart of ROKU pulled up. This is the 1 year chart of ROKU that is pulled up. And just take a look at what we have here. So down here, I have the RSI. The RSI is basically an indicator that shows you if the stock is overbought and oversold. So when you see up here, it gets really red, that means the stock is overbought. And then usually it would go all the way down here and becomes like blue. That means the stock is oversold. So let me just change the time frame real quick. You see down here, it becomes blue. That means it's oversold, right? So that's on the 4-hour chart. Let me go back here. So basically what I was saying earlier with looking at the stock and finding if the stock is overbought and oversold. Let's just look at this, right? This is the 1 year day chart of ROKU. And as you can tell here, and also please take a look at what's happening down here. You see the stock price goes up, reaches a certain level, and then it comes back down a little bit. And then you can tell that down here, the RSI also goes down. And then from here, RSI starts going up, reaches a certain level, comes back down. The same thing is happening with RSI. And then it goes back up, comes back down, right? So we're saying that there is a pattern here of going overbought and becoming down, in the range of being oversold and in between being oversold and overbought, and then it goes back higher. But this is the day chart, right? You see how the day chart it is. It's not really showing you that the stock is going all the way oversold, but what you can see is this stock has a pattern range of RSI that usually for it to be oversold here, it's like 46, right? It usually go within this range and then goes back up. So let's change this to the 4-hour chart. Now look at the 4-hour chart and see what is clean here, right? You see I have these this green line right here. This green line is basically a 150 moving average. What is a 150 moving average? Basically, it's just taking the price of this stock going back 150 days and then it's just giving an average of, you know, the price. So as you can see, this moving average is acting like a support, right? You see the price goes up, comes back, and then bounces off this line, goes up, comes, bounces off this line, goes up, comes, bounces off this line. So this line is acting like a support, right? So when you are on the 4-hour chart, it's showing you a range of like, okay, well, it's going up, coming down and bouncing off that support. And then when you look down here, you can also see that when the stock reaches the height, it's also overbought, right? It's super red. And then it goes oversold. The stock goes all the way down, and then it goes overbought again. The stock gets, the RSI gets red, and then it goes oversold and it's almost blue down here. And you can see here, it got really oversold here that, you know, the RSI went literally blue, right? And that's what I meant by, you know, basically having the stock being overbought and oversold, right? So this is just ROKU, a simple thing. So now let's go to another stock. The stock is called Bed Bath & Beyond, BBB, okay, that's not working. BBBY. And on BBBY here, I'll go to the 1-year chart. So let's look at BBBY. You see here earlier, I was talking to you about price gaps, right? You see here, you see this gap right here? It's empty from here all the way up there. There is all this emptiness right here. And then when you look up here, you see that there is another gap here. So this is the price gap that I was basically describing earlier. But in this case, when you look at here, see what happened. You see down here, this means that it was an earnings day, right? So they released earnings, the earnings was good. So the next day, the stock gapped up, right? So let's say if you had bought the stock somewhere here and then you put your target profit somewhere in here, right? The next day when the stock gapped up, your profit target wasn't going to get triggered or get filled because the stock gapped up. But hey, does it matter in this case? No, because hey, you're making more money anyway. But here's where I was saying it can impact you negatively is when you look up here. You see the difference from here to there, right? So that means, let's say that you maybe bought a stock somewhere up here because, you know, you saw the stock, it was going up and then you had FOMO, fear of missing out. So you jumped in here and then you bought this stock, right? So then when you jump in here and you buy the stock, and let's say you put your stop loss, you bought somewhere at $25 here or something, and then you put your stop loss like around $23 right here. But then the next day, the stock gapped down, boom, it opened down here at like almost $22.18, right? So then that means your stop loss didn't get triggered. Well, in this case, it's going to impact you negatively because you're going to end up losing more than you anticipated, right? So these are the things that you also have to be aware of when you are doing swing trading, because these can happen. You see that happened overnight, right? And that's why day traders don't like to keep stocks overnight. But this doesn't happen all the time. I mean, it's you know, it could happen maybe, you know, once every 3 months, or I don't know, sometimes it doesn't even happen on the stock for, 1 year, 2 years. It doesn't happen all the time, but it's just something that you need to be aware of, right? So then the next thing here is we also spoke about resistance and support and resistance line. As you can see here, I have traced these two yellow lines, right? So this line down here is a support line. And then usually when a stock gaps up like this, usually the place where the range or the level where it gapped up becomes a support line. And as you can see, the stock gapped up, and then from here it went up, it went all the way up here, and then it came back down here and then gapped down again, right? So it went all the way down here, it reaches this same level. Guess what? It bounced because that level became a support. And then now it goes back up again, and then it gets here, it reaches this resistance here, it bounces back, comes back down, and now it's down here, and now it's it reversed on Thursday of this week, and it's going back up. I actually bought shares on this on Thursday, and I believe I had sent in my order at about $18.06, right, somewhere right here. And then I believe, if I remember correctly, I put my stop loss somewhere around 16.5 right? So somewhere in this range, that's where I put my stop loss, and then my profit target is all the way up here. So when you look at this range from 18.6 all the way to up here, and from here all the way to down here, you can tell that this distance is bigger. It's more than twice as much as this distance from here to here, right? Because that is risk management, and you can learn a little bit more about this if you go and check out my video about making $100 a week trading penny stocks, and we will link that video above or in the description below so you can find it, right? So basically, this support line and resistance line help you decide where you're going to put your limit order, where you're going to buy, and then it also helps you decide where you're going to put your stop loss and where you're going to put your profit target, right? So it's really interesting here. So one thing also that I want to do is, let's go back to the 4-hour chart. Now look at the 4-hour chart. You see the 4-hour chart is pretty much a little slightly different from the 1-year chart, right? And here we can also look at the pattern of being overbought and oversold. You see here it was oversold, the price went up, it got overbought, it came back down, went even higher, super overbought, it came back down, and then got overbought, oversold, overbought, oversold, overbought, oversold. Literally, you can literally see the pattern. It's obvious here. And the good thing is, you see this 150 moving average is acting like a support line here. So, this is something to be aware of, and something that you can literally just, if you can follow basically how this works and follow everything that I just showed you, you can literally make money, and you can send in your orders at night or early in the morning, and you don't have to be there to be trading when the market is open. Your order can trigger itself into the market, and then you have a take profit target and stop loss order, pretty much, and it's going to do these orders and fill them out for you depending on where the stock goes, if the stock goes up or if the stock goes down. So with that being said, I'd like to say thank you for watching our videos, and please don't forget to give us the thumbs up, subscribe, and turn on that notification bell so you can get notifications of our videos when we post them. And with that being said, I will see you in the next video on Sunday. Bye.